David, I see you, and I'm going to promote you to panelists. I'm not sure if you're going to be sharing a screen. I think you told me no, but we should be able to see you, and hear you anyway. And
can you hear me now?
I
Hi,
get, hi, David. How
Dale.
are you?
I'm doing great, and really glad to be on. And I apologize if there's any kind of background noise, but really excited to be on, and great to
Yeah.
connect with you this morning.
Yeah. So you're waiting for the train. I like my commute, David. Which one room to another, and which bathrobe should I wear? So, so, buddy, why don't you tell us a little bit? I went to did a little work and took a look at your blog and a little bit of your commentary under your Twitter handle. So, I have a little bit of a feel for where your head's at when it comes to markets and the economy. You're a veteran. You've been around through
Yeah,
a few different cycles. Why don't you tell us about your first job in the trading, investing business? How did you get started? Tell us a little bit about point A, and now you're at point B. How did it happen for you?
sure. So my first, going back, during the dot-com bubble, I was sitting in my dorm room in college trying to get into the bubble and doing a bad job at day trading. Going back, two cycles, and then I ended up coming to New York and started out actually doing M&A at a company formerly known as Lehman Brothers back in the day. So I experienced that crash. I actually lived a couple blocks away during 9/11. So I was kind of part of the first crash of my career on the investment banking side of the world was learning about trading, but really kind of coming at it from the perspective of advising companies, and that then shifted over to to the buy side of things, kind of in the last up cycle, kind of the 2001, 2002, 2003 time frame. Moved over to the private equity world, and experienced what I would only refer to as a lesser version of the obscene credit cycle that we're experiencing today. As an allocator, so we were buying companies and rolling them up, and I ended up, I'd gone to school in undergrad to study philosophy and finance, but I went back to graduate school. I went to Harvard and I did a JD and an MBA because I wanted to kind of move over to the hedge fund world. So I went to Harvard.
Okay.
I focused on distressed. I actually was a research assistant and TA for now Senator Warren, who's running for president.
Wow.
I did that. Yeah, it was a pretty cool experience that I did it because I was focused on kind of what I saw as a really big credit cycle that had been brewing kind of ahead of the last cycle. So about, this going back 2005, 2006, 2007, I started my first blog called Paranoid Bull because I was worried the markets were going to collapse. I've been blogging every day and tweeting every day since 2007. I've sent over 100,000 tweets because I'm very optimistic in the long run. And I happened to kind of meet a guy named John Paulson, who was working, to do the subprime trade at the time through my connections at Harvard Business School. So anyway, so I had, been trading on my own and was shorting and kind of expecting the crisis that came last cycle. But rather than continuing to do that, and I worked at a couple of large firms. I worked at Canyon, which is one of the largest hedge funds on the West Coast. And
Let me ask you something about Paulson. Paulson came in before the hurricane hit in Puerto Rico and invested billions in Puerto Rico. I believe his expression was, especially with some of the new tax acts that came in there, that Puerto Rico was going to become the Singapore of the Caribbean. Does he still believe that? Do you know?
I'm still friendly with him and everyone at the firm. I'm not there anymore, obviously. And I think that it's kind of hard to know. I think these types of, I think that his view was a many year view. Like I don't think it was a kind of short-term view. I don't know. It's a short answer, and I don't think anyone can know.
Okay.
I do think that, anyhow, like last cycle, we got some things right being short, and then kind of got very long. And from, 2009 through 2015, I was actually very bullish, very long, kind of, a variety of different things, including private early stage companies, even helped to build kind of private early stage company from scratch, backed by some of the Silicon Valley folks. So anyhow, so around 2015, I started to get worried about the cycle again. That's when I started tweeting under the Paranoid Bull handle. So I've been tweeting under that handle the last few years. Have been, running an investment firm called Open River the last couple of years. And anyhow, I'm extremely bearish right now.
Okay, how was it to turn negative way early and have to deal with people who miss the upside?
Yeah, I mean, I think that the thing that happened, just to kind of, complete the, just to give you a sense of the way I think about things and where I think we are today and what I think's happened since 2015. So I think in 2015, what happened was there's sort of, there's two major cycles that matter. One is, I'll call the credit cycle, which, and I'm primarily domestically focused in the U.S. and primarily focused on, although I do kind of invest outside the U.S., primarily focused on individual securities. But what happens, from time to time when you have credit bubbles is you get defaults, meaning companies can't pay back their debt, they start to go bankrupt. And in 2015, we started to see a big wave of defaults. We actually saw the global economy start to slow down. China rolled over, and cyclical industry started to contract. In the U.S., default rates started to rise, and the U.S. equity markets hit like pretty important resistance levels. Well, the Fed at that time had a difficult decision to do. What they did is they decided to pause, and that's when the ECB went negative. BOJ did kind of their extreme, unprecedented QE, and China went ballistic with about $1 trillion in stimulus. So I think what happened at that time is they rather than having an ordinary credit cycle, what happened is they transitioned the cycle that we're in to a systemic cycle, meaning they took what would have been, a wave of corporate defaults that, we see every 7 to 10 years, and they've transitioned it to what I think is a wave of sovereign mispricing, meaning I think that the sovereign credit markets are obscenely mispriced. Political risk is the most important risk now, even more important than the fundamentals that we're seeing rolling over across industries.
Didn't they do the same thing in 08, 09? And if they had just let things unwind, we'd be coming out of it right now instead of facing potentially a bigger balloon?
Yeah, I think that what happened, yes, the short answer is yes. I mean, I think that the longer answer is that, I think that what we learned in 2008 was that systemic risk isn't just some theoretical idea that we hear about in textbooks. Meaning, in every financial textbook, there's this idea, they call it the risk-free rate, and there's these models, they call them CAPM and other models. And those ideas are based on this notion that there's some background systemic risk in the system that we need to compensate people for. In 2008, we learned that isn't just a textbook theory, it's an actual fact. Meaning, if credit bubbles get out of control, which is what happened leading up to 08, systemic risk can emerge, and it did. And so rather than recognizing that systemic risk is a product of the way things were set up, the institutions that were in place, the kind of way credit was allocated, the way that the credit bubbles developed, rather than kind of seeing that and modifying the system, what the central banks did and specifically the Fed did is bailed out the existing institutions, didn't really change much, and in some ways may have made things worse with some of the regulations that have been put in place since then, meaning Dodd-Frank created more illiquidity in the credit markets than existed before. What I mean is that they bailed out the old system. They then kept the incentives in place that created the last bubble. And then if you look at what's happened since 2008, since 2009 in the bottom, sure, markets are at all-time highs, but the credit bubble that we have this cycle is way bigger. The corporate debt bubble, the sovereign debt bubble, by pretty much any metric, debt is higher than it ever has been before. Same institutions, actually incentives are probably worse. We've got a lot more short-termism in the markets, a lot more kind of quantitative trading, not based on fundamentals. Passive investing is quite dangerous when it comes to market structure. So if anything, there's more systemic risk now than there was in 08. To your point, maybe the system could have cleansed, but it didn't. And now, unfortunately, we're facing a scenario where political risk is at the point where you really can't go a day without talking about it. I mean, between, even without the trade wars, I mean, if you look at what's going on in Europe, it's pretty extreme. You look at what's happening with Italy.
What's the
But
political risk in Europe?
the biggest political risk in Europe right now is that Lega, which is the leading party in Italy, has every incentive in the world to completely stand up to the European Commission in a way that Italy started to do last year but didn't. Meaning that Lega and the Italian people have been, well, basically Lega represents the Italian people, but Italy has been destroyed by the euro. If you look at what's happened, kind of going back, to prior to the European
So
Union,
the political risk is that Italy is one of the first to leave the eurozone in
they
favor
don't.
of the euro.
They don't even need to have. They don't even have to leave. So if you go back to last May of 2018, there was a 1 day rumor that Lega, which is the right, and the Five Star Movement, which is the left, that is kind of they're both combined to control Italy today. So they've joined, basically the far left and the far right are kind of a populist coalition that are leading the Italian government today. There was a rumor they might call a snap election. That's it. And what happened is the Italian 2-year sold off 200 basis points in 2 days. And what that means is that it's not even just a theory, it's a fact that if political risk materializes in Europe, Draghi can lose control of the sovereign credit market. Now, why that matters is that the entire.
How do you trade it? You trade it with a short euro. Your bias here.
So I think being short any of the Italian sovereign credit instruments, I'm sorry, with BTPs in Italy, you can be short Spanish sovereign credit. You can be short euro. I think it's more levered to be short either European equities, specifically financials, or BTPs, or Spanish government debt. French government debt's also fine. If you do it through futures, you can kind of, play the spread, the BTP spread versus boons, or the Spanish government debt spread versus boons. I think doing it on an absolute basis, meaning just short the bonds, is another way to do it, and kind of don't hedge the euro risk. I mean, to your point, the question of the euro versus dollar, there's some crosswinds in the short run, given what the Fed's likely to do, and kind of how bullish dollar has been. And
What do you think the Fed is going to do this week, David?
I think what they'll do is open the door to cuts. I don't think they'll cut this week. I think they'll but I think they'll start talking the market towards cuts in the next few months. I think it's probable that they'll begin cutting. I think it's quite unlikely to cut this week.
Okay, so let me ask you this. You talked about this happening in 2015, happened on a grander scandal.
Let me be clear about the difference between 2015 and today. So what I believe was likely in 2015 was that the credit cycle would turn, meaning we'd have a normal correction, like say, S&P 500 would be down 30%. We'd have maybe a mild recession. It didn't seem at that point that it was certain, or it seemed possible we might have a systemic type collapse like '08, but I think the likelihood was moderate at that time. I think today the likelihood is high that we will have a collapse on the order of magnitude of 2008. So I think things are far worse than they were when they began to normalize in 15. And the reason is because things were bailed out in 16 into 17. That the system, is actually at a much more precarious state.
Okay, how are we going to know that the next round of QE is not working?
So I don't believe it. So if you look at fundamentals today, so look back 2018, 90% of asset classes were negative, 90. Q4 2018, the GPIF, which is the largest pension fund in the world, had their worst quarter since prior to the dot-com crash. So the largest pension fund just had the worst quarter that they've ever had, basically in the last 20 plus years. In other words, the markets are already correcting. Well, in my opinion, what we've seen in Q1 this year is a bounce. I think it's kind of, people were getting negative into the into the end of last year. That Q1 has been a bounce. May was a bit of a normalization, and I don't think QE is working at all. If you look at end markets,
Well, we're
see,
not. They haven't launched QE yet.
yeah. So if you look at end markets, um, I think that fundamentals. So whether we look at export data coming out of Singapore last night at 30% year over year, we look at Korean export data down 30% year over year last month. We look at Chinese auto sales in May down 16% year over year. We look at semiconductors falling off a cliff. No matter if you look at end markets, you look at German GDP is now projected to be in the contraction in Q2. Fundamentals are rolling over. Fundamentals are actually worse now. So
Right.
looking at the
Which
chart that
is
you have
going
up,
to be the catalyst and why the Fed is talking about starting to cut again. Well, my question was, if they've been successful in '08 and they were successful in 15, how are we going to know that they're not successful in 2019 through 2021?
okay. So let's distinguish between '08 and 15, and then kind of explain why now is a little bit different. So 2008, first of all, the reason why they were able to do what they did is we were down extremely. We were down across all markets. We had systemic risk emerge. So in order to get, meaning the intervention that happened where the Fed bought assets, that is illegal. The Fed cannot do that without congressional authority. So, people who think, oh, the Fed's going to start buying stocks and buying bonds and kind of bail out banks, that is not possible today because the Fed does not have the authority to do it. So in 2015, it was a little bit different in that what happened was we started to get a credit cycle. What we got instead was the ECB started buying high yield bonds. The ECB went negative. The BOJ increased their quantitative easing and the Fed paused. Now, the US wasn't as late cycle then as it was today. China also did quite extensive stimulus. And so what happened is you had kind of the business cycle or the credit cycle. They got extended. They got interrupted. We didn't get a complete clearing of the business cycle. So now, if you look at margins across industries, they're even higher than they were kind of coming into that. It was an attempted healthy correction, and it was interrupted. So we're now later cycle across every industry. The U.S. is actually later cycle. China's later cycle. And Europe's later cycle. So if you look at automotive, you look at semiconductors, you look at cyclical industries, margins got extended to record highs. Earnings got extended to record highs. Margins of the S&P 500 are at 12 on an operating basis versus last cycle they're at 8. So like 50% higher operating margins of the S&P 500. So they kind of kicked the can on a normal credit cycle, and because of that, I think this cycle is actually we're now past where we were at peak in 2008. Now, your question about what can they do once things get as bad as they were in 2008 and will it work? I don't know. I think it depends on how it breaks. If I'm right and it breaks in Europe, the reason why I think it's most likely to break in Europe, meaning the sovereign credit markets break in Europe, is that Draghi has limited control. The ECB is a political institution made up of a variety of different governments that have limited authority. Draghi can only hold 30% of any issue of government debt at any point in time. He can't just go out and buy as much as he wants without a negotiated outcome, which is why it's really important that Italy is fighting back against the European Commission, because Italy has to agree to allow the ECB to intervene in their credit markets. And they won't unless they get the fiscal stimulus that they want. And the Germans don't want them to have fiscal stimulus. So when you start to look at the details of how this thing might break, if it breaks in Europe and rates, they lose control of the markets there, and the financial system, which Deutsche Bank is screaming that their financial system's insolvent, if the financial system's actually insolvent and they try to bail out that financial system, which I think they would probably try to do, by the time these things start to happen, given how late cycle we are in the global economy, the U.S. equity markets are going to be down way more than they were last year. I mean, last year was nothing. We had a beginning of a normalization, and if we're down, let's say 30%, which is not, I think, I would call that like a moderate downturn given how high multiples are and margins are. If we're down 30% U.S. equities, and we're in a proper credit cycle, credit markets are down, like 20%,
What
and
are they? What are the havens in that environment? Bonds, gold?
so I think unfortunately credit, being that short is the right positioning. I think that people, you know,
Net short
so
bonds as well because of sovereign debt problems?
that's exactly right. And
Okay.
rates, in my opinion, are too low, right? So it's like the problem is there's nowhere to hide, like literally nowhere to hide. If
Cash?
you look at it's so then we're getting into currency
Ca-
world, right?
yeah.
So yeah, so on net short, I think the right thing to do, if you're in my opinion, is to be net short. I think that gold could be a store of value. Things like Bitcoin, it's like a put option on fiat that's also a call option on technology risk. Like I wouldn't suggest that people put a large portion of the portfolio in something as volatile as Bitcoin, but it is a put option, on an alternative. Um, I do expect that gold's breaking out a little bit lately. I think that it shows you that people are concerned about all of the currencies. But again, I don't know that any of them are necessarily safe in the short run. That's why I'm not short. So
Okay. Oh,
personally think being short is the safest haven that you could have in an environment where literally, every asset class is overpriced and risk is, increasing by the day.
okay. So for the layman and not the expert, just be raising
Yeah,
cash and
yeah. Short-term
possibly
U.S. for a layman, I'd say this, FDIC insured, which is probably your best bet. Short duration, kind of treasury type yields of 2% are a godsend at this point. And
all right,
take a
let me ask you this. A lot of people think that our deposits at the banks are ours. We've had precedents in different countries of bail-ins. Could bail-ins happen here in the U.S. under those conditions?
I think that so let me just kind of say what I think is most likely to happen. I think what's most likely to happen is the markets will be down heading into the next election. Therefore, it's unlikely, as consensus as it is today, that Donald Trump will get reelected. If the markets are down in any way, like I'm suggesting, I think it'll be very difficult, for him to win. So we're going to have like a very contentious election going on if this stuff happens ahead of 2020. I do not think either side of this are going to let the individual account holders lose. Meaning, even if the FDIC is in a position, so Sheila Bair, the former head of the FDIC, came out last year saying she doesn't think the banks are capitalized enough. She knows what she's talking about. I don't know if she's right or wrong, but she sure as heck knows a lot. So let's say she's right, and the U.S. banks aren't capitalized enough. I think that politically, whether it's President Trump or one of the other party kind of coming into office, I think politically they will bail out the account holders. They won't let individuals lose money. Now, what that means for the dollar, what that means for the markets, what that means for the equity holders of the banks. I don't think if we get into that scenario, the equity holders of the banks are going to be treated nearly as kindly as they were last cycle. But
Okay. Yeah,
technically you're
because there's
right. But
no
I just
political will for a taxpayer bailout.
for the
But
for the
there,
equity holders,
yeah,
But when it gets down to it, push comes to shove, and we have a fight on TV,
the
between
bondholders.
the individual account holders.
Yeah.
To your point, I think technically you're right. There isn't a backstop beyond FDIC, and FDIC runs out of money. Like that backstop could go away. Then it's a political question, and I think the politics are either side, no matter who you pick, they're going to bail out the individual account holders. Now, what that means for the value of that currency, or the kind of what the world's going to look like at that time, I don't know. But that's why it's like not 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 the safest house in the world,
Okay.
unless yeah.
So, I mean, the kind of environment you're talking about, especially with the type of divisiveness and anger in this country, do you think that we could be, it's not just going to be a financial thing? You talk about political. Are we looking at social unrest in the U.S. on this next?
I think
crisis?
I think it's possible. I think that 2020, I call it the class warfare election. I think it's already underway. I think that, if you look at what's happened since 2008, QE has really been to the benefit of the wealthy. It's just a fact. Central banks have inflated asset prices, and wealth inequality has gone up in each of these countries. And so, to me, it seems quite likely that, we're going to have kind of, we already have political unrest. I think we'll have
So
potentially even more political
how are
unrest.
you preparing yourself and your family for what you believe and have conviction about?
So, I'm not short. I hate to suggest that folks should have a backup plan in terms of physically where they should go
Do
should
you?
unrest arise. Yes, I do. I do.
Okay,
I
interesting.
have a
Where?
physical.
Go ahead.
We just have a physical plan nearby where we live, a place where we know there's a generator and food, and I'm hopeful that we can avoid real unrest to the point of war. I think we can. I hope we can, but I personally have a plan. I've talked it over, with my wife where we go.
Okay. So you're
So
prepping.
I am prepared.
Okay. And and you're going to stay in the U.S.
Yes. Yes.
Okay.
Yes.
And why is that? If you have the means to go to a place that
I don't know of any place that would be safer, and I
really?
don't know that travel. I don't know that travel would be advised in a situation where we're having social unrest and have the risk of war.
Okay. Do you have an extra bedroom? All right, David. Definitely really, the alarm bells are ringing in this credit cycle because of the delays. We have to pay the piper. And how will we know? And we know the Fed's going to come out guns blazing, take rates down to zero again, maybe go negative. What's going to be our market tell
when
that
the
we have
equity market sell,
problems?
when the Fed cuts and the market sell off,
And how about that they're at the bond market, which is looked at as a
credit
haven,
default. Yeah,
rates
that's right.
go up, long-term rates go up, even though the Fed's trying to
That's
hold
correct.
down short-term rates.
That's correct.
Would you look for that?
I think it's quite possible long-term rates rise. I think that they'll actually rally first and then fade. But yeah,
Yeah.
equity markets sell off. We'll get long-term rates rally, but once they start fading, and then credit volatility is the key
Okay.
tell.
Is this
CDS credit vol.
deflationary? Is this deflationary or inflationary on the outcome? Do we bust first and then go into a hyperinflationary Weimar Republic thing, or is it 1930 all over again, where cash is king and it has great buying power?
So I think the asset markets will collapse, therefore, quote unquote, deflationary in the sense of asset prices falling. I think it could be inflationary in the sense of buying power becoming kind of worse. And so, yeah, I think it could be kind of a
Stagflation.
stagflationary type environment. What happens from there is political. So, I think it's going to be, unfortunately, we've delayed too long, and now we have to your point, pay the piper. There's consequences for actions, and now we're at that moment.
Okay, well, you lived up to your handle, paranoid bull, and maybe not so paranoid, maybe just not an ostrich with your head in the sand. So I really appreciate you spending some time and having a conversation with me today, my trading warrior brother. Like it or not, you are
Yeah,
now, and appreciate you sharing your views. And this is the best place for people to follow you, David, at
that's right.
Paranoid
That's right.
Bull.
That's the
And
best place to go.
when are you going to start updating your blog again?
I really primarily do it on Twitter, but I'll consider updating my blog more if you think it's a
All
good
right,
way to
let
go.
me
I've
do.
heard that a
Yeah,
lot lately.
why don't you do that? Because I think you're going to be a great resource during this time, and
Okay.
maybe you gave up posting because everything was delayed because of what Europe did and China did. But
No,
if
I
we're
just really Twitter. I enjoy Twitter. That's why
oh,
it's
okay.
really easier. I tweet
Oh,
constantly, but it's
oh, okay.
it's
You're like me.
you know,
I used to like to tweet, and now I have to tweet. So I'll see you at the next TA meeting.
that sounds good, man. All right. Well,
Twitter
thank you so much.
Anonymous, David Levine. Thank you very much for being with us.
Thank you,
All right,
Dale. Have a
buddy.
great week.
All
Take care.
right, you
Bye-bye.
too. Good luck on the Fed. So
Thank
that's a
you, sir.
wrap for us, everyone. Remember, don't just count your pips, count your blessings. And we'll see everyone tomorrow for Turnaround Tuesday. Good hunting. Adios.